Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Monster stock so we can determine if it's a buy or a sell. After we review Monster, we're going to look at KDP, Keurig Dr Pepper, so we'll value that company as well. Let's start with Monster. The company that originally created Monster was Hansen Natural. There are 34 drinks under the Monster brand. They're number one in the energy drink category, a 30% market share. Red Bull is number two. Let's get started with the model. This is a large cap company, 60 billion market cap. They're trading at $58 a share and they have 1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a lot of free cash flow in 2020, 1.3 billion. It went down to 700 million in 2022, back up to over 1 billion in the trailing 12 months. If a company has low free cash flow because they invested a lot into CapEx, that's not such a bad thing because investment in CapEx may lead to greater free cash flow in the future. But if a company has low free cash flow because they have low operating cash flow, that could be a problem. Net income is the profit or loss on the income statement. It's revenue minus expenses. That seems to be going down from 1.4 billion to 1.3 billion. But it's in a fairly tight range, not a big concern. Revenue is the sales for the company, and that goes up each year from 4.6 billion up to 6.5 billion. Pretty nice growth. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 65 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $53 billion. We divide that by 1 billion shares. And we get a calculated stock price of $50. They're trading at $58, so they're trading at a 14% premium. It's a sell according to the model. Here's their most recent income statement, the first quarter of 2023 versus the first quarter of 2022. Revenue increased from 1.5 billion to 1.7 billion. Let's get a breakdown of their revenue so we know what it is. Just by seeing how the company generates revenue, you can learn a lot about them. Like for instance, a lot about the products they sell. You might not know they sell alcohol. 46 million of their sales are in alcohol. Of the 1.7 billion of revenue, 1.56 billion is from their main product, their Monster energy drinks. 86 million strategic brands, 46 million alcohol, 4.6 million of other. Of the 1.7 billion of revenue, 1.1 billion in the US and Canada, 300 million in Europe, Middle East and Africa, 131 million in APAC, and 144 million in Latin America and Caribbean. And I'm kind of curious what strategic brands are. Let's search this term to figure out what this 86 million represents. Strategic brands is mainly from selling concentrates and beverage bases to bottling companies. This is how Coke makes a lot of their money, by selling the concentrate and having other companies manufacture the product and sell it to the retail stores. The way the bottlers make the drink is they combine the concentrates with sweeteners and water to make the beverage. And they have their own manufacturing facilities. Then the manufacturing of the drink is complete. Then they could sell cases of it to distributors, grocery stores, wholesalers, club stores like Costco, gas stations, tons of businesses. The alcohol revenue is by selling kegged and ready-to-drink canned beers, hard seltzers, and flavored malt beverages, primarily to distributors in the US. Alcohol brands has a lower gross profit margin compared to their energy drinks. They did an acquisition in 2022. They acquired Keurig, and that increased their alcohol revenue. They also have the Beast Unleashed flavored malt beverage. They add a lot of new products, alcohol and non-alcohol. This is what they added in the first quarter of 2023. Burn Watermelon Zero Sugar, Java Monster Cafe Latte, Rehab Monster Wild Berry Tea, Ultra Energy Citrus Peach, lots of new things. And some of these products aren't new to Monster, but they may be new to certain countries. So that's why it's on this list. Any new product or new in a certain region is included here. Their gross profit is revenue minus cost of revenue, 900 million, up from 776 million. This income statement's better because it has percentages. Their gross profit margin is up from 51% to 53%. Revenue went up 12%, cost of revenue 8%, so their margins have improved. Since revenue went up more than the cost of revenue, their gross margins went up 16%. They're spending less in operating expenses as a percent of revenue. Last year was 24.8%, now it's 24.3%. The way to calculate the 24.3%, it's operating expenses, $413 million, over revenue, $1.7 billion. Gross profit minus operating expenses gives you your operating income, $485 million. Operating margins of 29%, up from 26%. So it is impressive they improved their margins. Even with inflation, they seem to be doing a lot better. Their income before taxes are $500 million, taxes of $100 million, so their tax rate is 20%. The way you calculate the 20%, it's taxes over income before taxes. So 100 million over 500 million is 20%. Their net income is up a lot. It's almost 400 million. Last year was 300 million. So their net margins improved a ton from 19.4% to 23.4%. 4% or 400 basis points. Earnings per share went up from 28 cents to 38 cents. Last year they sold 169 million cases. This year 182 million. That's a lot of cases. That's an increase of 8%. Here's a breakdown of their products by revenue and operating income. The revenue for energy drinks is $1.56 billion. Operating income of $560 million. So margins of about 30%. Strategic brands have even better margins. Sales of $86 million. Operating income of $52 million. Because for this category, they just sell the concentrates to other companies, and those companies deal with all the manufacturing. So it's all profit, it's all margin. They lost money in alcohol brands, $46 million of revenue. They had a loss of $7 million. Hopefully they can grow this segment to where it's profitable. If it doesn't become profitable, they may just sell off that unit. Let's look at their operating cash flows. The way you calculate operating cash flow, you start with your net income, that was $400 million. Then we have to add back the non-cash items on the income statement. We have to add back depreciation and amortization, $17 million. We have to add back SBC, $16 million. Then we have to adjust for changes in working capital. It looks like they sold a lot on credit, meaning they sold products to a customer but did not receive cash, $167 million. That's why it's a negative in accounts receivables. But when these customers pay for the products, it'll be a cash inflow in that accounting period. Last year, they bought $200 million of inventory, so it was a cash outflow. And this quarter, it looks like they used some of that inventory. They used $35 million, so it's a cash inflow in this accounting period. They reported an accounting profit of $400 million, but generated $425 million of cash flow. Last year, they reported an accounting profit of $300 million, and had negative $350,000 of cash flow. It was mainly from the big investment in inventory. Let's take a look at their shares outstanding. It looks like they decreased their shares 14 million, so they bought back some stock. They currently have 1,045 million shares outstanding. Last year they had 1,059 million shares outstanding. Let's look at the stock on Simply Wall Street. It last traded at $57 a share, 60 billion market cap, up 24% in the past year. Monster Beverage engages in development, marketing, sale, and distribution of energy drink beverages and concentrates in the US and internationally. It looks like there was significant insider selling in the past 3 months. Here's where the stock has been trading since 1992. It looks like since 2005, the stock pretty much went up almost in a straight line. There were some dips, but it recovered pretty quickly. Last month, the stock reached its all-time high, close to $60. The stock is up about 120% since the COVID bottom. Here are some news and updates. Monster was dropped from Russell Top 200 Value Index. Monster might be having difficulty using its capital effectively. Back in May, the price target increased 7% to $60. That was a pretty good estimate because it's pretty much at that point right now. A bunch of stock sales right here. First quarter EPS exceeds analyst expectations. They started in 1985, 38 years ago. Here's their PE the last 5 years. It was 36 in 2018. Its lowest point in the past 5 years was 27 in March 2020. It's currently at its highest point since the stock price is going up. It's at 44. Price to sales peaked in 2020 at 11. It's down to 8.7. Price to book peaked at 9.5. It's currently at 7.6. Simply Wall Street values the company at $50. They say it's 14% overvalued. That's almost exactly where I valued it at. And I don't look at Simply Wall Street until I do my valuation. Actually, this is the first time I saw their valuation because usually my number is way different from theirs. Most stocks are really undervalued on Simply Wall Street. I'm sure you've noticed. 24 analysts priced this stock and the average price target is 62. They say the stock is 8% undervalued. The revenue forecast for 2025 is $8.8 billion, which is $2.3 billion higher than their current trailing 12-month revenue of $6.5 billion. Monster is one of the rare companies that never uses debt. They're pretty much always debt-free, as you can see by the red line here. And their equity is higher than ever at $7.4 billion. They do not pay a dividend. The average in the industry is 2.7%. Rodney Sachs is a CEO. His total compensation is $15 million. His regular salary is only $1 million. His tenure as CEO is only 2.5 years. In the past year, there's been no insider buying, just selling. About 53,000 shares have been sold in the past year. 67% of the company is held by institutions, 20% by public companies, 8% by private companies, and 5% by the general public. If you own this stock, you're part of that 5%. Their biggest shareholder is Coca-Cola. They own 20% of this company, 200 million shares valued at $12 billion. They've been adding employees each year. They had 1,700 in 2012, 2,600 in 2017, 3,300 in 2020. It's currently at 5,000. And this ticker trades on the Nasdaq, Deutsche Börse, Wiener Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. Now we're going to look at Keurig Dr Pepper. This is a beverage and coffee company. This new company was formed in 2018 between the merger of Keurig Green Mountain and Dr Pepper Snapple Group. They sell over 125 hot and cold beverages. Let's get started with the model. This is a large cap company, 44 billion market cap. They're trading at $31 a share and they have 1.4 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow was $1.9 billion in 2020. Then it jumped up to $2.5 billion in 2021 and 2022. Now it's back down to $1.9 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that jumped from 2020 to 2021, then back down to $1.3 billion, where it was in 2020. Revenue is the sales for the company, and that grows steadily each year from $11.5 billion to over $14 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $52 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $46 billion. We divide that by 1.4 billion shares. And we get a calculated stock price of $33. They're trading at $31, so they're trading at a 5% discount. It's a small buy according to the model. There are 15 companies in the same industry as Monster and KDP. And if either has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. Both companies spend a fairly small amount in CapEx, but higher than the median. Monster has no debt, so their debt to equity ratio is 0. KDP is 0.5. For every dollar of equity, they have 50 cents of debt. Monster does not pay a dividend. KDP is 1.3%, which is lower than the median, but higher than the average. KDP generates a lot more free cash flow than Monster. Monster ranks third in market cap at $60 billion. KDP is fourth at $44 billion. Both are pretty far behind Coke and Pepsi. KDP has a really good price to book ratio. Monster is at the median. The PE for KDP is the median. Monster is worse than median and average. Similar with price to free cash flow, KDP is strong, Monster is weak. And KDP has a better price of sales than the average. Monster, not so much. KDP generates more than twice the revenue as Monster. And they're growing at a 34% annual revenue growth rate. So it looks like KDP is a pretty strong buy, at least according to some of these numbers. They're both growing a lot more than Coke and Pepsi because Coke and Pepsi are huge. It's hard for them to grow at 10-15% clips. Here's their most recent income statement, the first quarter of 2023 versus the first quarter of 2022. Revenue is up from $3.1 billion to $3.4 billion. Let's get a breakdown of the revenue so we know what it is. Of the $3.4 billion of revenue, $2 billion is from beverages, $930 million from coffee, and $400 million international. Let's look at a different breakdown. Liquid refreshment beverages, $2.2 billion. K-Cup pods to make the coffee, $900 million. Appliances, sometimes they sell those coffee machines, $137 million. And other, $100 million. U.S. beverages, $2 billion. U.S. coffee, $931 million. International, $415 million. All the expenses directly tied to generating the $3.4 billion are $1.6 billion. Revenue minus cost of revenue gives you your gross profit, $1.7 billion, up from $1.65 billion. All the expenses not directly related to generating the revenue, $1.16 billion. Those are called SG&A. SG&A increased $147 million quarter over quarter. The increase was from inflation, stock awards, and also higher marketing and increases in operating costs. Here's a better view because it has percentages. Their revenue went up 9%, cost of revenue went up 13%. So that means their gross margins declined since their cost of revenue increased more than their revenue. The margins went up only 6% year over year. SG&A went up 14%, the $1 billion to the $1.2 billion. Their operating income went down quite a bit from $966 million to $584 million. It went down 40%. Interest expense also went down a lot from $188 million to $23 million. It went down 88%. The improvement in interest expense was a mark-to-market gain. Their net income is down from $585 million to $467 million, a decrease of 20%. So their EPS is 33 cents. Last year was 41 cents. Here they give a breakdown of their margins. Gross margin, 53.6%, down to 52%. Operating margin, 31%, down to 17%. They did decrease their shares outstanding by 12 million. Last year they had 1,418 million. Now they have 1,406 million. Let's look at their operating cash flows. In the first quarter, they only had 71 million of operating cash flow. Last year they had 663 million. The big difference was accounts payable. Last year they had a cash inflow of 150 million. This year they have a cash outflow of 400 million. That's about a $550 million swing. This just means they extended credit to their customers. They should get this money. It just might not be for another month or two. Let's look at the stock on Simply Wall Street, trading at $31, 43 billion market cap, down 13% in the past year. They have a bunch of risks. Debt is not well covered by operating cash flow, unstable dividend track record, large one-off items impacting financial results, profit margin negative 9%, lower than last year of negative 19%. This is where the stock has been trading since they merged companies. That was in 2018. Its lowest point was when COVID hit. It fell below $20. Its highest point was in the middle of last year. It hit $40. It's down about 20% since that peak. They should be reporting their Q2 results on July 27th. Upcoming dividend of 20 cents, a yield of 2.5%. Here's their historical PE. In 2018, it was 61, its highest point. It's currently at 38. Same thing with price to sales. Its highest point was 5. It's currently at 3.5. Price to book has been getting a little worse. It was 1.4. Now it's 2. That means its market cap is double its equity because price to book is market cap over equity. Simply Wall Street's valuation is $50. They say the stock is 38% undervalued. 19 analysts priced this stock and the average price target is 38. They say it's 22% undervalued. Their current revenue in the trailing 12 months is $14.3 billion. The forecast is for the revenue to grow to over $16 billion by the end of 2025. In 2012, their trailing 12-month revenue was $4 billion. Same thing in 2018, but then they merged companies and it blew up to over $10 billion. Now it's over $14 billion. They can cover the interest payments with their operating income about 5.5 times, and their debt to equity ratio is 49%. Debt of $12 billion, equity of $25 billion. In 2012, they only had $480 million of debt, but when they merged companies, that grew to $16 billion, but their equity also grew to $22 billion. Ever since they merged, their equity has gone up a little and their debt has gone down a little. They pay a yield of 2.6%, payout ratio of 84%, so their earnings are 94 cents, dividends per share of 80 cents. They're paying their next dividend on July 13th. So you need to own the stock by June 28th to get that dividend. And you can see they raise their dividend pretty much every year. It was 60 cents per share in 2018. Now it's 80 cents per share. The forecast is for them to pay 90 cents per share by 2025. And the yield is around 2.5% the past few years. The forecast is for the yield to be almost 3% by 2025. The CEO's salary is $1.4 million, total compensation $12.5 million. His tenure as CEO is less than a year. In the past year, there's been a lot of insider buying, some insider selling. You can see it's a pretty long list. This is a little easy to look at. You can see the shares sold were a lot more than the shares purchased. Someone sold over 30 million shares. That was Mondelez in February. They sold 30 million shares, $1 billion of stock. And that's a pretty big company. They make Philadelphia cream cheese, Oreo cookies, lots of products. 57% of the company is held by institutions, 27% by VC and private equity firms, 12% by the general public, 3% by public companies, and 1% by insiders. Their biggest shareholder is a German company, JAB Holdings, 27% of the stock. Their value is close to $12 billion. JAB owns a lot of companies. They own Peet's Coffee, Einstein Bagels, lots of companies. They had under 6,000 employees in 2012. But post-merger, it's gone up a lot. They're at 28,000 currently. And the ticker trades on the Nasdaq, Deutsche Börse, London Stock Exchange, EuroTLX, and Wiener Börse. So that's the end of the video. I hope you enjoyed it. Leave a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.